Thank you so much for joining the session, Why DFSPs Don't Want to Join Your Network. I have two great voices to talk about this, offering different contexts. The CEO of Higala from the Philippines, Winston Damarillo. Thank you, Winston. And then from Zambia, we have Mr. Robert Piri, who is the CEO of the Payments Association of Zambia. Thank you, Robert. If you guys can share that, sure. Okay, thanks everybody. Please persevere with me. This is my first panel discussion, so not just something that I'm getting used to. My name is Philip Green from the Mojo Loop Foundation, and a pleasure to have you all with us today. So I think in my previous lives, I've watched over some pretty thorny technical integrations into networks for national payment interoperability in the DRC and Sierra Leone and Angola. At the Mojo Loop Foundation, we spend a lot of time focused on technical integrations, and Sachi from ThitsaWorks is going to talk a little bit more about how we're trying to reduce the costs of that. And there's a lot of work done by the partners in that space. But there are also blockers that go well beyond integration issues, and that's really where I'd like to take the conversation today. So I think maybe kicking it off, Winston, maybe you could just give just a brief background on what Higala is doing in the Philippines.
Great, thank you. So my name is Winston Damarillo, I'm CEO of Higala. So Higala means my friend in the Philippines. Our goal in the Philippines with Higala is to enable instant payments for everyone. I know we talk a lot about inclusion. We initially thought that's just for individual inclusion, but one of the really important things actually to think of when you're enabling instant payments is institutional inclusion. How do you get rural banks, community banks, fintechs to participate? And I was going to propose a change to the topic. Is that what does it take to get a DFSP to join your network, right? And that's what we've been doing the last 2 years in the Philippines. It's a fairly large implementation already. The Philippines, not Mojo Loop yet, but the Philippines today processes about 500 million transactions per month, about 1 trillion pesos, which is roughly about $200 billion. The challenge in the Philippines, and then we'll kind of drill down on this a little bit more, is that there is an established implementation. And to introduce something, even if it's better, cheaper, and faster, there are hurdles to get everyone to participate in that. So our journey in the Philippines has been, the switch was the easy part. Getting the DFSPs to participate was a bit more complex and was addressed by combination of nudging the regulators to amend regulatory frameworks in the Philippines, number one. Number two, providing a technical solution so that DFSPs, including large ones, would open their minds to participating in more than one switch. And then the third is, how do you encourage big guys to help little guys, right? Which is, how do you get established DFSPs to help small DFSPs, like rural banks, to become a part of the network? And I think that's the overall formula. And that's been our journey in Higala, and so we can drill down on it a bit more.
Thanks so much, Winston. Robert, maybe you can just give a brief background on what Payments Association in Zambia does in Zambia. And a small background to, I guess, what the NFS provides in Zambia.
All right, thank you very much. So the Payments Association of Zambia was established as an initiative of the Central Bank of Zambia in 2019. It's a platform where DFSPs sit and collaborate with regulators and the government in just driving financial inclusion and innovation in the space. Particularly, our role is to provide an opportunity to revise or review policy. So we speak to members and then provide input into the development of policies, regulation, and laws around digital financial services in the country. We so far have supported the government of the Republic of Zambia in formulating the National Digital Transformation Strategy, as well as formulating the National Financial Inclusion Strategy, Vision and Strategy. as well as piloting the National Financial Switch 2 project. At the moment, we are also supporting the central bank in conducting the FinScope survey, which is a survey that basically just looks at how people in Zambia and businesses have access to and usage of financial services. So in a nutshell, that's what we do. Thank you.
Great, thanks very much for that. Winston, I wanted to ask, in the Philippines, Higala is bringing, I guess, banks and non-banks together. What are some of the early barriers that you've encountered?
We got invited and we thought the problem was the switch was old and the cost was high and it's difficult to participate. That's the obvious one, right? And so we did that. We tackled that problem. Mojaloop, I think we deployed Mojaloop 16 at the moment, addressed that issue. So when you do a comparison to the existing switch and what we are able to do with Mojaloop, you can drop the price at least a quarter, down to a quarter. So you heard a lot this morning about friction costs being a barrier to instant payments. So that's the first step, right, to kind of remove or reduce the friction cost of instant payment. But then once you solve that, there's a bigger issue that you have to deal with, right? So for instance, in order to introduce another switch to an existing large implementation, you need to enable the DFSPs to be able to traverse two switches, right? That requires a router in order to make that happen technically. The other issues that we run into is that now when you have two switches, then you've got two settlement engines. So you need two RTGS systems that talk to each other. That's kind of the second problem, right? And then the sort of the second to last mile issue that we're noticing is in order to do digital payments, you need to have a digital platforms. And most last mile providers, rural banks, community banks, cooperatives, MFIs, the community we're supposed to service, they don't have digital infrastructure. So you almost need to like build your own very lightweight version of a core banking system and a digital app so that last mile gets delivered. So that's why I said, what does it take for the entire DFSP ecosystem to really participate in instant payments? It's really a combination of that. But we had to go through all of those. And the final thing we had to do, which we just did, is even support the legacy system. Because if you don't understand the legacy switch of the existing ecosystem, like in the Philippines, the big DFSPs will never support it, right? They'll never, they want to know that the incremental investment they're going to need to do to support the second switch is incremental, not another switch support, right? So there's some technical gaps, there's some regulatory gaps, and then there's a mindset gap that we needed to kind of go through. But I think that's kind of normal. I think assuming that it's a switch-only problem has been kind of our early naive understanding of the market, and understanding that it's an entire ecosystem participation kind of help in adjusting that thinking for us a bit.
Thank you. Thanks. Robert, moving a little bit to Zambia, from your experience in Zambia, do you feel like DFSPs are hesitating to join the NFS, and what would be their reluctance? I know that they're mandated to, but still they may have reluctance.
Yes, the mandate is there, and I think that's what helps to get everybody on board, so that then the teething problems can be resolved as and when everybody else has joined the network. But I think the major issue that we see is the cost associated with integration. That becomes a very big concern, especially for small DFSPs. But what we have done in the country is to sort of stagger the payments, so that then they don't have to make one payment at onboarding stage, but that payment can be phased. So you do some sort of deliverable-based payment plan. That helps. And then in terms of there are also other issues, in terms of when they connect, there's a possibility that some businesses, particularly the small ones, could lose their brand visibility because maybe the bigger players will sort of overshadow them. And that's where governance, structures come into play. But one of the things I think that has been mentioned from the experience in the Philippines is the technical capacity for the DFSPs to be able to do something of this nature. And so what we do then is, while you are talking to the DFSPs as an association, we do provide the technical expertise. If we don't have that within the association, we then look for third-party providers to be able to provide that technical assistance during that process. We found that to be very helpful because then it allows the DFSPs to feel part of the process and they own it, rather than just waking up as a regulator with a whip and commanding or demanding that everybody be connected. So those are some of the issues that we have seen in terms of the hesitation. So it's really just the cost as well as the technical expertise. But then there's also the issue of the mindset, right? You're a small player, so you're thinking, once I'm connected, the bigger players are going to have the bigger chunk. But if you're a bigger player, you're also thinking, I have invested in this infrastructure and this system, right? But I'm going to give this access to a small player that has not made any investment, and that small player could even have access to my customer base. Those are, concerns that we have seen. But ultimately, I think what works is having that regulatory direction from regulators, and then convening all the players together and showing them really that the enemy we are all fighting is not a competition. The enemy we are fighting is cash and how we can digitize these processes. And no single entity can do that by themselves. We all need to be able to work together, the regulators, big players, and the smaller ones. Yeah.
Thanks so much for that, Robert. And I guess touching on the big players and the small players, Winston, I don't know if we can drill a little bit deeper into like maybe a business case that you made to not only the smaller DFSPs, but the larger DFSPs. Part of it is money sharing. There's a separate follow-on question that I would like to ask you about costs, which are not integration costs, but switching costs.
Yeah. So the moment they stop talking about inclusion and talking to them about sustainable revenues, the big DFSPs start talking, right? So the Philippines have three large ecosystems. One is a very dominant wallet vendor called GCash, about 99% market share in the country. Then a dominant group of unibanks, where 8 banks kind of control the country, and then 300 rural banks that's spread across. And the old battle cry was like, let's get everyone in payments and get them all included. And what that really meant for the big banks in the Philippines is that you're giving little banks access to my clients. And they were resisting it. The national retail payment system, when it was enacted as a law, had resistance, right? Because all these beautiful bilaterals that I've created goes nowhere. Now it's a network-based interoperable system. So that took a while to get over the hump. As more and more of the wallet vendors beginning to take payments market share out of banks, the banks start worrying about it. And then they started opening their minds to, what if I become a wholesale bank? And so one of the examples we used in the Philippines was the idea of platform banking. So in the US, platform banking is predominant, right? Big banks created a branchless, appless bank that serviced other banks. And so one of the things that we were able to do in Higala is to prove that there is a business model that is sustainable and works for the big banks to provide kind of a super DFSP, basically. They are the front-facing bank to the network, and they're kind of a host bank to a lot of tenant banks that are the smaller banks. So that worked. The other thing that then followed that is the idea that you can help smaller institutions participate in payments without CapEx. And that helped a lot, right? It's a business model that basically shared the revenue derived from payments between the platform bank provider, which is a bank, and the tenant bank that then delivered it at the last mile. And then we get our cut as a switch vendor. So it kind of works as an ecosystem. It kind of mimics the whole interchange model, Visa and MasterCard. So using their model to disrupt them from that perspective. And so that typically works, right? I think you need the regulator to move a little bit, in their regulations. So we initially had a monopoly of ACHs, in single ACH formulation in the Philippines, that has since been opened up to allow multiple switch providers. The Philippines is now following a model of the United States of platform banking, that so that big banks can lend their license, their regulatory compliance engines, their ability to do large treasury and settlements, and can then host smaller banks. And so that expands the participating in institutions of instant payments in the Philippines. And that's kind of the path we're taking, because we're neither government funded like PIX or UPI, but not completely commercially funded like Zelle or FedNow or RTG in the US. So we're somewhere in the middle, and that's kind of what it took, at least for the Philippines, to create this community of participants in our instant payment systems.
Thanks, Vincent. That's a fascinating space to be where you're sitting between those two. Robert, this may be a controversial question in terms of the Zambian context, but when we're thinking about costs and using the switch, and maybe even whether it's reliability, are bilateral connections still a better option for some of the bigger Zambian players? And is that indeed legal or used at the moment?
Well, I think from the way we see it, bilateral partnerships should only be a starting point and not the end. I think the end should be full interoperability. And the costs attached to, just the switching fees is relatively very, very high, especially for smaller DFSPs. And so when you then begin to talk about bilateral partnerships, it brings in other threats as well, like the issue of having to allow your brand to sort of be overshadowed by the bigger brand. But then there are also issues around data protection. Bigger players may have, stronger systems in terms of protection and compliance on data protection laws, whereas the smaller ones may not have that capacity. So if you're a bigger player, then you're thinking, once I interoperate, I allow my system to be able to interoperate with the system of a small player, then that means that I'm risking myself. And here's the situation for the Zambian business. In terms of compliance, as a bigger player, there are certain customer segments that are deemed to be very high risk. One of the situations that we had to resolve was when some of the mobile network operators pulled out of their agreements, partnership agreements with aggregators, because these aggregators were targeting betting companies, and that's high revenue, but also very high risk. And so the conversation now is the bigger players are saying we want to be able to manage such customers by ourselves because the risk is high. But then when you go on the ground, what you find is that the people with the information and the customer base for merchants such as betting companies, it's the aggregators. They are the ones that have the KYC and all of that. So these conversations are really difficult. But I think what helps really is the coming together of minds, the meeting together of minds, and knowing that we have to be able to work towards something. And that goal is full interoperability, where each one is allowed to play their role in the ecosystem. That works to the benefit of everyone, from governments to the people being governed. So those are the conversations. In terms of the financial switch, we do have our own challenges. And I think there's been concerns around whether it's able to handle the volumes that are currently, being pushed. The conversation really is, prior to 2019, we were much of a cash-driven society, but COVID-19 sort of pushed us in a place where people needed to find ways and means of making payments and doing business. So that has pushed a huge drive in terms of dependency on the usage of digital financial services by the population, and the numbers keep increasing. And the biggest pusher for that one is mobile money. That has been the biggest driver. So these are some of the conversations we are having and we are looking at. And so people are now concerned, do we need to maybe, upgrade our national financial switch so that then we can expand it so that it allows for, seamless integrations with all the players in the market. And I think I would have loved for the Bank of Zambia to have been here to respond to this issue, but conversations have started, and we know that there's willingness for the clearinghouse to be able to facilitate and support a process like that. Yeah.
Great, thanks for that. And I guess I had a follow-on question, just around the data and the risks. Do you feel that do you think that the larger DFSPs will have more trust with respect to data privacy and everything if they go through the switch as opposed to the bilaterals?
I do agree, partly because, firstly, I don't know what the perceptions are in other countries, but there's this undertone, subliminal message that the bigger players play, and the understanding is that that customer data is theirs, when in actual fact it is not. It belongs to the customers. And so that's what sometimes even validates, for lack of a better term, their position to not want to interconnect and interoperate with other systems, because they're thinking, this is my data, but it's not in actual fact. So there are issues around data protection that we need to work on, and it helps when you have an independent institution such as the clearinghouse, where all of these transactions can be happening as opposed to bilateral arrangements.
Thanks for that. Winston, just on, I guess, talking about trust and governance, and given that you aren't either private or sort of government owned, and so maybe have less of a mandate, are there certain governance structures at Higala that have helped build confidence among the participants?
I think there's two layers of governance that we have to look at, and you have to look at it from two perspectives, at least for us in Igala. One is a clearing switch operator, and so from that perspective, we now become the most important chain of a continuum, right? So an operator like Igala would need to have even more deeper SOC 2 compliance, even better PCI DSS capability, even more adherence to ISO 2701 standards, and even more understanding on about ISO 222, right? So you got to lead that charge ahead compared to all the participating banks, because you're now kind of that central point. And then capacity and scalability are two important things. So from that perspective, that's become now a much deeper, your mission critical provider of financial infrastructure in the country, and that we're regulated. We will be regulated when that happens. The other layer is where we delegate trust to the platform banks. And this is really important, especially at the beginning. Most large unibanks have invested quite heavily on anti-fraud, anti-scam, cybersecurity systems, and those don't scale down well, right? A small rural bank cannot afford to do that, cannot afford sophisticated KYC, cannot afford biometrics, all that kind of stuff, right? So for a country like the Philippines, where there's a new realization by the biggest banks that they wanted to become wholesale banks and they wanted to become platform banks, they're able to take on that responsibility. They're able to give central banks the comfort and confidence that the necessary consumer protection is adhered to by somebody they know, and then delegated to a degree to the platform banks the responsibility to then screen the tenant banks. So from that perspective, for instance, a tenant bank serving a betting company can easily be removed, because the fraud detection system of the large unibank will detect that quite quickly. So it's a shared responsibility, I guess, from that standpoint. It's a non-negotiable for the operator. You got to be as compliant as the most complex bank there is. But the other way to then propagate instant payment to more institutions is that idea of platform banking. And I think in most emerging countries, and it's even proven by developed countries like the US, that's kind of a good on-ramp to getting everyone to participate in a way that the central bank will trust, in a way that customer confidence will be there. So I might be an unbranded rural bank, but I'm running, for instance, at Banco de Oro or RCBC, the two large banks in the Philippines. So the consumer gets that confidence. I think that's important because we're transitioning the market, and that was an element that we used.
Thanks. I've just got a little another question for you. But in terms of, you've got small banks and big banks, and I don't know if there's maybe an example you have of where small banks want one thing and big banks want another thing, and then you might be the mediator in between. And how will you make a decision that would seem
you almost need to like move up and think like a banker, right? So the big banks want ADB, they want deposits. The little banks want transactions because that's day to day. They make money doing that, right? And in between, there's kind of a settlement thing that they have to do. So, for instance, if a small bank becomes a tenant of a big bank, they need to do what's called a pre-funding deposit, right? That allows them to transact within the capacity confine that the big banks provided to them. The big banks get the benefit of a higher average daily balance coming out of that transaction. They make money from that and the money they make from becoming a platform bank. But then the smaller banks get to participate in instant payments and make margins without capex. And that's kind of a win-win relationship. But at the end of the day, what's really important in instant payments is to stop thinking about it as a single function app like P2P payments, which everybody feels. I feel like that's an addiction, right? Everybody's stuck in P2P payments. I think at some point, once we have a lot more use cases in instant payments, then there's a lot more money to share and more participation. And we stop talking about reducing the cost and just making it a part of how we do business going forward.
Thanks for that, and I'm glad you brought that up because it's something that I wanted to raise, is that we talk about interoperability and inclusion, and Michael Ganza was talking about, I guess, you can have instant payments, but and highly effective in Kenya, but not necessarily completely inclusive. And then we talk a lot about interoperability, but I feel like it often stops at P2P. And that's where we are in Zambia. And so, Robert, I wanted to ask that, if we look at potentially adding merchant payments into the network, onto the NFS, currently the mobile money operators are not actually directly represented on the NFS. So, do you feel like that? Do you feel like that prevents them from wanting to engage on say, for example, the interoperable merchant payments? Or
yeah, so these discussions are ongoing. There's very little that I can comment on, but I do know that that's one of the hesitations, actually. There's been a push from the mobile network operators to be fully integrated on the NFS example, because then there's no need for me to have that cash. So yes, we do need to be able to get all the players onto the NFS, and we needed to do that like yesterday as a situation for our country. But obviously that has to be, the process must be, phased so that you do not disrupt business. I think there has to be enough time given to the players to be able to understand the process and what the costs associated with that process are, and then finally then getting them on board when everybody else has been onboarded. There's also the issue of just a lack of trust from the merchant side, because many times what we see is that regulation tends to focus on the players rather than the end user most times. So you have a lot of convincing to do to the merchants for them to be able to adopt digital payment as a mode of them being able to receive or to make payments in their business. And because it adds an additional layer of costs, most of them would be very hesitant to do that. And that's where now cost-effective systems and networks become handy, because then you don't need to convince them that it's cheaper. They'll be able to see it for themselves. Yeah.
Thanks. Winston, do you see how do you see moving to merchant payments in the Philippines or are there use cases?
Well, reduce the cap on P2P. Number one, it's really not hard, but it takes will, right? So, for instance, a lot of the merchants use P2P as payments to merchants, right? In the Philippines, you got 5 mobile phones, right? Because if one capacity gets booked, another one I think that needs to be I think it's a conscious decision to enable that, right? It has to be a negotiation with the regulators and the banks. For instance, there's a lot of pressure to keep reducing the cost of P2P everywhere in the world, right? But then the cost to deliver P2P is not changing as much as our intent to make it lower, so you have to change the model. And there are countries that starts out with the free P2P, and they really necessarily have to then enable P2M a lot sooner. I think in countries like the Philippines, we're addicted to P2P. Everybody's P2P in the Philippines. And so I think that as the caps on P2P, I said the cost goes down along with the caps. So as an example, no more than 2,000 pesos, no more than 5 transactions per day. Then you eliminate the hacking of the use case, basically, and enable the merchants. And then there has to be a reasonable MDR that the merchants can expect. Looks like that number is somewhere between 1 and 1.5%. And if you offer that to the merchant where it's hardly impactful to their bottom line, and you offer them the convenience of you get your money today or instantly, supposed to when you clear after your credit card stuff. There has to be a conscious decision to sell that, and there has to be uniformity in the way you accept payments. So there shouldn't be five QR codes in every store. There should be one. In Philippines, is a unified QR strategy now, so that works. I think we're in that next step of encouraging people to pay their merchants, encouraging merchants to accept payments the right way. And then I think the final piece here is just to reduce the caps on P2P, and that will just slowly move the behavior across, hopefully.
Thanks for that. I think we're almost out of time, and I didn't want to leave time for 1 or 2 questions. So I think maybe to wrap up with a last quick question for each of you, and I think this goes back to you wanting to change the title. What's one lesson you would share with anyone trying to get DFSPs on board onto their payment network?
I think you have to understand their business model, right? A wallet vendor behaves differently than a Unibank, behaves differently than a thrift bank, behaves differently than a cooperative. And I think one of the things that hopefully we at Moduloop begins to realize that there are 4 different use cases and 4 different DFSPs and motivated 4 different ways. Then we kind of start tailoring what we offer a little bit differently. But understanding their economic models are important on the provider side. Then you can motivate them appropriately. And I think thinking of this only as a technical problem was kind of our early misconception. And it is our job and I don't even want to call ourselves hub operators because that means we're only doing switches. But it's really, if you want to enable instant payment in a national scale, you got to think in the entire ecosystem. And, just dealing with a piece of it's not enough.
Thanks, Vincent. And then, Robert, sorry, I know you're not a hub operator, but if you have one piece of wisdom to share in terms of enabling DFSPs getting on board to a payment network.
Yeah. First of all, I think for regulators and hub operators, there has to be a deliberate approach in terms of adopting or adapting to changes in the landscape. These changes are happening every day, and many times regulation tends to follow the technology and the changes that goes with that. So that only happens when you're constantly engaging. And so stakeholder collaboration becomes very, very key. And I'm glad to share that from our country, we have the National Collaborative Framework that was established by the central bank. And it comprises all the players, the regulators, players in the market, banks, and the aggregators and fintechs in the sector. So that's one of the things that we see works. But an essential part of this also involves hand-holding the DFSPs. We shouldn't make an assumption that they know what needs to be done. Most times they don't. They may know what they need to achieve in terms of their business, but what the technical understanding of the onboarding processes and the risks associated with integration, that may have to be something that is communicated during the process of onboarding. So that technical hand-holding support is very, very key. Thank you.
Thanks so much for that, Robert. I wanted to see if we have any questions. We're in the red now, so I think maybe we can take two questions. Is there any questions? Going once, going twice. Yeah, okay. Well, you know Winston and Robert now, so Winston and Robert, thank you so much for taking the time. This is really insightful. We have one question.
My name is Muta from Bank of Tanzania. And thank you, Winston and Robert, for your insightful sharing. I just wanted to understand, in terms of merchant payments, how as hub operators would like to react in terms of supporting micro merchants vis-a-vis the large merchants that are ready to pay the MDR and the interchange fees.
So I think it starts with the definition of the last mile. Micro merchants, most of us are in emerging and developing countries. They go to their community bank. They don't go open an account from a digital bank, right? And so what we've discovered in the Philippines, and I think Julie and I got an opportunity to come visit them, is that you have to enable the last mile nearest to the micro merchant. So if I sell fish in the wet market, I need to be able to still cash my money out at the end of my day, right? So having a relationship with my community bank, my rural bank, is really important. And it's a two-way street. We did convince then the rural bank that if they take digital payments, to make the investment to provide a digital app and to support instant payments, that they will get more micro businesses opening bank accounts with them. So I think that you need to take it down to that level, so that the gig economy worker, the micro merchants, we call them sari-sari stores in the Philippines, the micro stores, right, have this confidence that while they're beginning to ramp themselves into digital payments, both paying and receiving, that they have somewhere in the near proximity that can still offer somewhat traditional banking service or near cash. Kind of our strategy to get micro merchants to participate. And I think when that happens, the MDR of 1.5% is not impactful for them. Especially if other use cases come into play, like they can now borrow money, they start creating credit scores for themselves, they start creating business track record. So there's an education that needs to happen in enabling micro merchants, and a confidence building process that needs to happen, which needs to include banks. We need to really include our community banks. If we lose our community banks, micro merchants will have a hard time.
One more question there. While we're waiting for the mic to move, I'd say from my experience in Zambia, offering some sort of grace on tax would also be quite useful.
Hello everyone, my name is Yuri Walter. I come from a company called Resilient Payment System East Africa. I have a question specifically to Winston. And this is basically specifically to you in terms of your country, in terms of the switching aspect of it. So we happen to have an opportunity of implementing a shared system with a major credit union federation in the Philippines. So our work was basically to bring a shared core banking system, a shared switch that is actually going to switch the card transaction, whether it is ATM and POS. So this one is specific to your country. Maybe you might not have much insight, but since you are a switch operator, maybe you can help me to understand in terms of now comparison your company, that is Egala. And we got an opportunity of working with BankNet. Yeah, so we were integrating them. And integrating with the BankNet has made a document to go through it. If you request support, they are not there. you are being taken here and there. So, well, my question is, that is my experience with BankNet, and I personally, in terms of leading my team, I even feared interacting with them. What is unique in terms of Igala? If, for example, we say we tell the client that why don't we work with them? So the reason why I'm saying this is that from other countries that we've worked, API documentation, an online API documentation and sandbox is something that is now, it is something that needs to be implemented in the past. With BankNet, we never saw that. So there is no sandbox environment of testing anything, but you are being rushed for a period of time. I think you understand. Let me not talk about.
So BankNet is a really good institution. It's owned by the banks in the Philippines. I think you might be talking about their vendor, right? In the Philippines, instant payment systems is run out of a platform called Vocalink, built by MasterCard. So your technical experience probably relates to that. And the Philippines is getting better. So the country is adopted to ISO 222, which I think is good for everyone because then it has that common way for us to work with a country and its ecosystem. So that's happening in the Philippines. So it's going to get better. Second, and what's different with Higala is we're, like I said in the earlier conversation, we're not just focused on individual inclusion, but institutional inclusions. We want rural banks, last mile providers to participate in the network. So we're a lot more keen to work with you, right, to enable an ecosystem because that's the constituent we serve. And we do believe that if you create a business model where a payment is made and every participant of the ecosystem makes money, sort of like how interchange works, right, except at a lower price, then there's a community approach to fixing the problem. So come back to the Philippines, give us a call. But I think it's much more open now from that perspective. And Mojo Loop obviously is an important platform for that because, you know, that's what we espouse in the country, right? So open API, everybody can participate. It's really more business model innovation that we're bringing.
Great, thank you, Winston. Sorry, I might have to cut questions, and please get hold of Winston and Robert afterwards, as we started a little bit late, and now we're going 3 minutes over. So Winston and Robert, thank you so much. Really appreciate your inputs. Thank you. Thanks, everyone.